This Forecast Conference has brought leaders from across business, political, and nonprofit communities to work through challenges and opportunities in the San Fernando Valley. VICA's Business Forecast Conference is one of the premier events in Southern California, with the best economists available, bringing together knowledgeable economists, business leaders like yourselves, who are given information that will help prepare them for what the future holds. We're glad you joined us today to discuss flamin' hot. We've got some great panelists from transportation to government reform to public safety and many more. Let's thank our economic forecast sponsors this morning. Let's start with Bank of America. Thank you, Bank of America. Let's give them a round of applause. I said sponsors, but it's sponsor, so we will only be thanking Bank of America. The question many of us have is, which direction is the economy going, and for how long will it stay there? Our speakers have prepared some important information for us, and we hope to have some time for Q&A at the end. So let me introduce our economists very quickly, and then we will get started. First, Barbara Bagley, CFA, Managing Director and Market Investment Executive with Bank of America Private Bank. She will be followed by William Dolan, California Regional Investment Director, U.S. Bank Private Wealth Management. Barbara, we'll start with you.
Thank you, Cameron. Since we didn't have a tech run through, I'm going to look around a little bit for the clicker up here. Let's see. Great. Okay. So thanks for coming out, everyone. It's early and it's a Friday and we're all in suits. So I think I wear suits a little more often than Cameron, but still a struggle. The topic today. I'm going to give a little bit of an economic forecast. It'll have a market bent. I'm actually not an economist by training. I've been working in the markets most of my professional career. So I'll have a market bent, and I'll talk about our forecast for the rest of the year and maybe even getting into 2024 if my crystal ball is working as well as it should be. So basically, we've had a lot of airplane analogies for the economy: soft landing, bumpy landing, no landing. And we've also had a lot of weather analogies. So we went with the weather analogy, talking about our outlook here. So we've got some tailwinds. The good news is we're at historically low unemployment. The economy's been very resilient. Nobody a year ago expected that third quarter 2023 would clock in with a GDP of 4.9%. So that's just much higher than expected. So the GDP reported this week was 4.9%, again, much higher than expected. We attribute that to full employment and healthy consumer spending. The jobs market's, the majority of the reason, but we're still seeing a little bit of the sort of COVID sort of back to work and back to vacation and back to activities after COVID. We saw a lot of that last year, what we called revenge spending, and the revenge spending's continued. It's shifted from buying goods to services and travel. That was evident in the price of airline tickets. Those have finally started dropping. And we finally got through all of the supply chain issues from last year. Last year, there were several major supply chain issues, and that limited the goods that were available for purchase. So we've been through that, and there was a lot of goods purchases. Now we're moving on to services. And then lastly, in May this year, we kind of had a new market trend. It's not really new, but more better noticed by the markets, which is alternative artificial intelligence, the generative AI. A lot of you probably have been following this trend. It's not exactly a new one, but it is a very important one for the future of labor. Okay, so the headwinds, we put these slides together at the end of the third quarter. The biggest headwind right now is heightened geopolitical risk. And that's the bottom last point there, but we've got 2 wars going, and wars are inflationary. So what's surprising is that energy and oil prices haven't shot up a lot, and we think the indication here is that we think the war in the Middle East will stay contained to the region it's in now. And I suppose that's good news. But any signs that expands to the rest of the region, we think oil prices would be a lot higher. Right now, oil prices are still in the range they've been in for the last sort of 2 months before this broke out on October 7th. China and Europe have had really slow growth. They're basically in a recessionary type of trend. And one of the big disappointments this year was the comeback. China was supposed to reopen and give us very good consumer spending and importing, and that hasn't happened. So China's much slower, Europe is much slower, and so there's a whole region of the world that's really, not participating in any type of recovery. Another sort of, negative, the inflation is starting to catch up with the consumer. Spending's still good, but it's slowing. So one of the most complicated things for economists is to figure out where we are in the business cycle. And I don't think anyone's really figured that out yet. At one point we thought we were very late in the cycle, and later, about halfway through the year, just based on the numbers, well, it looks like we're still sort of midway through the cycle. So Bank of America officially is not forecasting a recession at this point for 2024, but we're forecasting a slowdown. And so, a slowdown that could be positive growth of, 0.5% or 1%, that's not great. And we are forecasting a pretty dramatic, we're starting to see the numbers come in. So whether or not it actually meets the definition of a recession is, sort of beside the point. We think we're going to have slowing growth next year. But, again, so far consumer spending has kept things, from getting really contractionary. And S&P earnings, we've done a lot of S&P earnings these last 3 weeks, and the earnings are actually up from a year ago. Margins are coming in, but earnings are up a little over 1% in aggregate so far now. And that's good because, again, it sort of supports the corporations and corporate spending. One of the interesting things about the market is all of the things that should be working in the late cycle are not. So this group of industry sectors, consumer staples, healthcare, industrials, tech, real estate, most of these didn't work at all in the stock market. The stock market was pulled along by a couple of very specific trends, and it surprised a lot of people. Last year, if you remember, was a really negative year. The S&P was down 22%. We ended up bottoming in October, about a year ago. So a year ago, I think it was mid-October, the S&P completed about a 25% decline from January of 2022 to October of 2022. October is notoriously volatile, so we're really not surprised. The good news for me is there's only 3 trading days left in the month, and I can't wait. We've got a couple big catalysts in November, but this month, since July, the S&P is down about 9%. So we're still pretty far above last year's highs, but we've also seen a pretty big contraction from July, the last time we got earnings. All right, so, again, I think this chart, the red ball was a little closer to the top of the hill about 3 months ago, and we've moved it back down. In general, I would say that we're going to have this conflict over what part of the business cycle we're in for probably the next year. And what we've observed is that we've got a little bit of a rolling recession, where interest rates hit different sectors at different times. And so we've seen some sectors really taking a beating that you wouldn't expect to be down if you're headed into a slowing growth environment. But it's just the rates are catching up with different sectors at different times. So I think that's something to keep in mind. All of the interest rate sectors have had a very tough go of it. Okay, here's a little recap of where we stood at the end of September. And I think the points I want to make here, I'm actually going to step away here. Okay, no mic. The really interesting point here is that, sorry, basically despite all of the headwinds and the concerns about the economy, the areas that have really kept the market up were the biggest surprises. They're very pro-growth sectors. So technology far and away has been the best sector of the S&P, and that pulled along all of the other equity sectors. A lot of the other S&P sectors are down, but NASDAQ is still up about 20% for the year, even after kind of a rough week. Amazon's bucking the trend, so that's good. Amazon's bucking the trend. Yeah, you're up today. Yeah. So we've had tech really pulling up the rest of the equity market. High yield was another thing that no one expected to do well. High yield basically are bonds that are below investment grade rating. And come into the year, everyone was expecting a recession in 2023. Didn't happen, and corporations did a great job refinancing themselves. So corporations did a very good job extending their debt at low interest rates. So we've seen very few defaults. At least the defaults we've seen have not been in publicly traded debt. And that's a big difference for the market than in prior historical market cycles. So the corporations did a good job refinancing their debt. High yield is actually the only bond sector that's positive. The gray sector, the gray bars indicate how negative things are. Municipal bonds are down, treasuries are down, and remember, a year ago, Fed funds rates were about 50 basis points a year ago. And now we're at 550 basically. That's huge. So we're up about 500 basis points in 18 months. And it hasn't really started to catch up yet, but it's starting to catch up. You know, the Fed has this expression, long and variable lags. So long and variable lags before the interest rates really hit the economy. But it's starting, you know, the lags are starting to catch up and the higher rates are beginning to have an impact. So bonds are pretty much down, again, except for high yield. So this is really contrary to what one would expect. And that's why I think a lot of people have heard the term cross currents to describe the markets this year. The other thing that's been great has been energy and commodities. Not all commodities, copper's been down. But if you look at the bars over on the far right area, that's energy. And again, the economy's hung on more than expected, so energy hasn't really declined as it typically does heading into a recession. The geopolitical issues are kind of front and center right now. And so again, like we've had crude staying in a range, but if it looks like the conflict's going to spread to other regions, it's likely to go up. Gold's had a bit as well. I think the biggest surprise is that typically when you've got geopolitical tensions, you get a sell-off in yields and bond prices appreciate. So that hasn't happened this time. The 10-year Treasury is over 5% for the last, it's down below 5% today, but it's traded above 5 for, you know, about a week of this month. Okay, next slide here. This is just a mosaic of how sort of disparate the returns have been through September. You know, you can see the tangible assets as commodities, and that typically, it's done by year. And you can see that the commodity complex is actually, it's indicated just right along there that we've got inflation. And, you know, inflation's fallen from 9% to like the high 3s, CPI measure. So through the end of September, commodities were off. But again, I think the big question for the market is whether the Fed has done enough to consistently lower inflation. Okay, we're going to get to the actual forecast. We're going to get to that soon, but just a couple more slides on the market breadth. So I think most people have heard the term the Magnificent Seven, which not just a movie, but it was the term for this 7 mega cap stocks. Amazon's one of them. But the 7 mega cap stocks that have really led the market, they sold off dramatically last year. So there's some school of thought that says that the appreciation this year is really just an earnings, kind of a bounce because they were oversold last year coming in. However, if you take the top decile of stocks out of the S&P 500, and you look at this chart over here on the right, the red line indicates how much lower the S&P is without these top stocks. So if you get rid of the largest stocks in the S&P, the rest of the market's had a very bad year. The rest of the market is down at this point. And I think that's why a lot of people looking at their brokerage statements will say, gosh, I hear the market's up, but I'm flat to down. And it's really because most of the market is down. Most of the market is getting repricing from interest rates. Okay, this chart shows where 10-year treasuries have been historically and where they are now. So the blue line right now is our 10-year yield. It hit 5%. It's backed off a little today. But this basically shows that despite the Fed's attempt to rein in inflation, the longer end of the curve, the longer maturity bonds are a little uncertain about where's inflation going to go. So a lot of people were able to refinance their mortgages at 3.5%. Those days are over. The 10-year is pretty comfortably in this range. It may drop down to 4.50, but our view is that we're not going to get back down to zero rates ever. Like that day has passed, and we're just in this higher for longer range for a very long time, and the market's got to settle into that. And it's really, you can call it a regime change, a mind share change. Like it's really a mental shift where both consumers and corporations are going to have to get used to higher rates. And the higher rates are going to take a bigger part of the budget. The green line shows the inflation-adjusted 10-year. And what's unique about this is even though the 10-year is at 5%, when you adjust for inflation, it's barely positive. So inflation's been so high that your bond returns, which were negative for years compared to inflation, have just barely eked out a positive return here. But again, we think real rates will, eventually the inflation rate will come down enough so that bonds will continue to offer real rates. And for the first time, I've been at Bank of America since 2010. This is the first time I've been excited about bonds and talking to my clients about bonds. So that's, really the first time in my investing career since the wake of the financial crisis that I actually thought about buying a bond for myself. But I'm thinking about it. And I think at this point, rates have corrected enough to make it very appealing for longer-term investors to start trying to capture cash flows. And we are advocating for our clients, even the ones that were very pro-equity, to start considering bonds. Cash flows are really attractive, and we think the Fed will be successful in getting inflation down. Okay, the curve is still a little inverted. This is maybe a little bit technical. But the point is the Fed can only control money market fund rates and the front-end federal funds rate. So they've raised it. The initial plan for the Fed when they started raising rates was to bring unemployment up to 4.5%. That was what the Fed initially said when they started raising rates. They thought employment would drop and that we'd have higher unemployment. That hasn't happened. I personally think that's a blessing for the economy. We want people fully employed and we want people spending money. That really supports the economy. But things haven't worked out the way the Fed wanted. So the Fed has really talked about this 2% inflation target. Whether or not they get there, we're skeptical that they're going to get to 2%. We think that the Fed is ultimately going to have to maybe waver on that a little because 2% is going to be a hard target to get to. It's really like a marathon. The last couple miles are the hardest, the diet. The last, part of your diet is just the hardest. Those pounds are the hardest to lose. Okay, so I'm going to skip ahead to our forecast here and just get to that, just in the interest of time. Oop. Eating dessert first. So the forecast basically a lot of strategists, including ourselves, have shifted our forecast. We had initially forecasted a lower GDP, but at this point, we're looking at sort of, at least for the US, a little over 2%. We may actually raise that with a strong third quarter number. Globally, about 3%. So GDP annualized is still growing. The Fed funds rate, there's a Fed meeting next week, and we think actually the Fed meeting next week will be a pass. We're not going to get another rate increase. And the market right now is pricing that perhaps July was the last Fed increase. Strategists haven't said that yet, but the way things are going with spending and a lot of the leading economic indicators are declining. So it may be that the Fed's done raising rates. They have not said that. They've really maintained this 2% inflation target. There's 2 more Fed meetings between now and the end of the year. Again, we think the meeting next week will be a pass. They've basically said that, so we're not expecting a rate increase then. The meeting in December, I think that's still in play. But if the economic numbers continue to decline, it may be that they pass there. I think the Fed is very keen to avoid the mistakes of the 70s, where in the 1970s, inflation looked like it was declining, but they never really got a consistent decline, and then it would rise again, and then they would have to raise rates again. And it made for this stop-start type of economy where corporations couldn't quite figure out what the rate environment was going to be. Consumers, it was just a confusing environment because directionally it was going in a lot of different directions. So the Fed is very keen to avoid the mistakes of the 70s. And, I think that's why the dialogue's been so hawkish. Okay, so next year we are expecting rates to fall in 2024. 2024 is not on the slide, but we expect at this point a 50 to 75 basis point rate cut in Fed funds rates. Now, because the Fed funds rates are at 550, that only gets it down to 5. So the point is it's going to be higher for longer. And that higher for longer sentiment is just something everyone's going to have to get used to. I'm going to just do 2 more slides here in the interest of time, and I'm going to go pretty quickly because they're the things people ask most about. Commercial real estate. We do think commercial real estate is going to be an issue. It's been an issue. The banks are basically renegotiating a lot of the loans, but it's very specific bank to bank and city to city. So commercial real estate's an issue, and frankly, the deficit's a big issue. The deficit has really not been discussed until recently, but we think the Fed is basically having to issue more treasuries, and the Treasury's got to issue more bonds in order to keep it, to keep us afloat. So we expect some tough fights over spending. We now have a Speaker of the House, so we think basically the Speaker of the House drama, that's over. The continuing resolution lasts until November 14th. We expect them to kick that out into 2024, April. So we don't think there'll be a government shutdown. Okay, so I think in the interest of time, I'm going to let Bill kind of pick up where I left off.
Thanks. Thank you, Barbara. Appreciate that information. Good morning, everyone. Hopefully my slides will populate, or maybe I need to cue it forward. So I was thinking about this morning, and I'm trying to come up with some economics jokes. And I realized there is nothing funny about economics. That's it. That's it. All right. So appreciate that information, and I'm going to try to kind of add to that. Upfront conclusions. So we're thinking, we're private wealth, so we're looking at this from the lens of investments. We've got balanced portfolios because there are those headwinds and those tailwinds, and we're going to talk about those things, and I'll show you some data to support that. I'm also going to sort of see how California varies a little bit from the global and the national data. The central question, so we keep talking about interest rates. Fed raised interest rates 7 times last year, about 4.5%. They raised interest rates in 2006 8 times, but they only raised 0.25% each time, so 2% throughout the whole year. So a really dramatic hike, and that impacted a lot of things: asset prices, real estate, anything that had cash flows became less valuable. And we saw that dramatic drop last year. Consumers are a huge part of our economy, about 70% of our economy. So that flows through the information about stock prices, what they're buying and spending on. So that's the central question. Inflation remains persistent. So clearly and better, right? Last summer, 9.1%. Most recent print in September, 3.7%. It's a lot better. But as Barbara mentioned, kind of that last mile really sticky, and we'll look at why that is. So the analogy is the economy like a runner on a treadmill, and that incline, the steepness of that incline being interest rates being really significantly higher. It's by design. The Fed is trying to slow the economy, right? And they want to see higher unemployment. Unemployment is very low across the country, 3.8, 3.9% nationally. In California, that number is about 5.1. California tends to run higher with unemployment because we have a younger population than the nation here in California. We also have a big tourist industry, so leisure and hospitality, part of the job sector that's not fully recovered yet, although improving. So we're seeing that improve, but not yet there. So a little bit higher unemployment here, but the economy in California is growing at a pace better than the nation, although we'll have to see, because yesterday's numbers, as you saw, at 4.9%, very hot on growth. So we'll see. It had been running higher. We see better job growth here in California. And there's a few factors here. So the onshoring of technical activities, this advanced manufacturing that we see here in California. Housing, right? We'll talk about housing a little bit. I have a bunch of slides, so I'll try to get through those. I think the slides are going out to you guys, so if I skip through them, you'll have those. But transaction activity falling off big time in housing, but prices still being resilient. You've got government spending at about $60 billion, so the third highest in the nation. You've got that fiscal policy, and this is across the country, that the administration is spending a lot of money, the government is spending a lot of money, and that's sort of at odds with what the Fed is doing by being contractionary with raising interest rates. But those things bode well for California and the economy. This slide here talks about the money supply. And it's something that we'll see throughout a few slides here, this idea of level versus trend or direction. So you can see the M2 represents kind of all the money in our system, including time deposits and bank deposits and checking accounts, things like that. So you can see the trend prior to COVID, and then really accelerating during COVID, the government trying to support the economy through that difficult time, the money supply really going way high, about $5 trillion above where it would have been had we not had COVID. And then now trending down. So more money, theoretically, implies more inflation, something called the quantity theory of money. Money supply times the velocity of money, how many times a dollar changes hands, is equal to GDP times inflation. So if we raise the money supply, theoretically we have higher inflation. That's not the only driver of inflation. Clearly, supply chain issues last year was a big driver. That's a lot of demand for consumer goods, supply not really meeting that demand, that imbalance causing a lot of inflation. It's gotten much better, but the sticky parts now are wages, right? The labor market, this low unemployment. There's about 1.5 jobs available for every job seeker. That's pushing wages higher. Business owners know that. So the macro environment, so this is a leading indicator that it's a proprietary tool we have. It's below average, but improving. We're seeing some of that data improve. Fiscal policy, I talked about that. Government spending, the amount of fiscal support is at quite high levels, going back to really only 2 other times. The Great Financial Crisis, we saw a lot of support there, and then during COVID. So we continue to see that sort of, fighting with this contractionary policy that the central bank is undertaking to cool inflation. So Barbara talked about these 7 leaders, if you will, in the S&P 500. 7 big companies, Microsoft, Amazon, Apple, Alphabet, NVIDIA, Meta. Those companies, by the way, 4 of those companies are right here in California. So for those folks that talk about population is getting smaller in California, it is. People leaving, this great exodus of California. We saw 500,000 fewer people in the end of 22 than we did in 2020. 39,500,000 in 2020, 39 million in 2022. So does it feel a lot more roomy here in Los Angeles? No. But there's a reason people are leaving. You know, primarily it's housing prices here. You know, that's a real concern. So interest rates going up affect a lot of things, and certainly mortgage rates are one of them. So a couple of years ago, 3.5% to get a mortgage. Today it's 7.5%. So for a family that has an income of $100,000, a couple of years ago, they could afford a house of $660,000. With rates at 7%, that's about $440,000. Average house in Los Angeles, median house, I should say, is I think around $880,000. So that's a real challenge. And then you go to other places in California, and it's even more dramatic. So there it is, the Fed raising interest rates. You know, that's what it can do. I mean, it can play in the far end, you know, in open markets. It can buy bonds and things like that. But it's raised that treadmill ramp, if you will, to be quite steep. And what we haven't yet seen is that impact consumer so much yet. And that's really what we're looking at. So this idea of balanced is we haven't quite seen the impact of these higher rates fully through the economy yet. Consumers had a lot of saved up cash in their bank accounts through COVID support and the labor market being so strong and higher earners continue to earn. Had a lot of savings. I have a chart there. I don't know if we'll get to it, but it shows it levels quite high. We're starting to see that dwindle. Consumers are still spending. They're staying up with the higher prices, so 9.5% last year than the year before, still over close to 4% higher than last year. So high prices, high borrowing costs, right? That's going to impact consumers, which then flows through earnings of companies, right? And then potentially stock prices. But then again, we have those tailwinds as well. So we're taking a balanced approach to our investments. I bought a 20-year treasury for someone recently because the rate is over 5%. That's pretty darn good to lock in 5% for 20 years. Why would you do that when you get 5.5% for a 6-month? Right, a bond is a loan. You're loaning the government money, you're loaning the state money, you're loaning Coca-Cola money, right? You want them to pay you back. The longer you loan them the money for, the more you should get, theoretically. Why would you lock in 20-year loan and only get 5% when you get 5.5% for 6 months? Well, because probably the economy will slow down at some point, and then the Fed really need to lower interest rates, and you've locked in something longer. Here's guidance from the Fed and the market's implications and where we vary. So those are the dot plots. The Fed board gets together and they give us an estimation of where they think the Fed funds rate will be in the future. So you can see the market really thinking that there's going to be cuts sooner than the Fed central bank is implying with these dots in the near term. But then when we go out further, Fed dot is lower below 3%, and the market, through its futures markets, is implying potentially higher rates. Yep, so we're in the same camp. Probably second half of next year, we'll see some Fed cuts. And that potentially will have the opposite effect on asset prices that we saw last year with all of these hikes. Now, not nearly as dramatic and fast, but could be supportive. And again, we feel similarly with bonds that, look, I mean, we've seen the sell-off in bonds last year based on that very accelerated rate hike environment. You know, we don't clearly see that going forward. They may be another 0.25% hike. We'll see. The number yesterday, 4.9, really a high number. You know, what the Fed does with that. but you know, not likely to raise the way they did last year, and now buying bonds at these higher yields. With municipal bonds for California investors, those are tax-free, you know, at the state and the federal level. And so when you think about the equivalent of that, if you buy something that pays you an income that is taxable, what would you have to be? And those are approaching 10%, 9, 10%, you know, and you can lock those in for a long period of time. So we are looking at not fully going out on the curve or in those longer durations, but maybe laddering out. Makes sense. This quick chart here, we've seen oil prices, so in the gray, that's the oil prices. Typically, we see drilling tracking with oil supply with a little bit of lag, oil prices go up, we see drilling start to increase. The far right of the curve there, you're seeing that a bit of a divergence. We see prices going up. We don't see the drilling keeping track there, and that's potentially, well, there's some political aspect to that, but also ESG or environmental issues potentially. Just interesting data there. So I think, so what this chart shows you here is that at the bottom you can see the forecast of GDP January, right, going forward. And then October, those are the newer forecasts. What you're seeing is this idea of slow down being pushed out further. And clearly the number yesterday at 4.9% is evidence of that. Here's the global forecasts. Eurozone forecasted to trend down. United States fairly steady, so forth. Capital expenditures, so 70% of the economy being consumer spending. Business spending is another element, as is government spending and net exports. So we have not seen really a drop-off in capital expenditures or businesses spending, and so we're tracking that. We'll see if that trends lower. That'll be an indicator. Inflation, we've talked about that, right? 3.7%, it's been sticky. Wages, housing, that last mile potentially being hard. Right, so either the Fed needs to we need to get to 2% on inflation, or the Fed needs to kind of give up on that, and we'll see. Persistent wage growth, we discussed. Decelerating, but still high inflation. Consumers have excess cash, right? Those are the deposits I talked about. You can see it hooked down, it's getting lower, right? Level and trend I talked about before, still high level, but trending lower. And that's inflationary, right? You have more money in the system to buy goods and services and assets. So that remains high. Consumer savings rates declining, right? So lower savings rates declining, relying on credit more. So these are leading indicators of potentially, you know, slowing consumer spending. Credit card rates, right? A couple of years ago, rates were extremely low. So this idea that not only are prices higher, but borrowing rates are higher, and that's going to ultimately impact our spending. Delinquencies very low still, but ticking up. Okay, housing. I think I touched a bit about housing prices. Really, this is a supply-demand issue. We don't have enough houses in California, certainly, for all the people, the 39 million people we have. It's pushing some people out. Activity level has fallen off about close to 30%, meaning transactions, sales. People are not selling their house. If you locked in a mortgage a couple of years ago for 2.5%, 3%, you're not going to sell and then buy another house and take a mortgage for 7.5%. So there's fewer inventory by far, and the transactions have fallen off significantly. But prices have remained. So we saw prices peak last spring. They were accelerating 20% year over year at that point. They dropped off about 14%, and now we've picked up again on housing prices, again, that supply and demand. And so, you know, people have been resilient, housing prices have been resilient. This is an interesting slide. So the light blue is showing where the average 30-year mortgage is, 7.5% now, if you were to go get a mortgage. But the blue line sitting just below 4% is the existing mortgages, where they are now, right? This pool of mortgages, they're all averaging around 4% or below. So that's an indication of how the monetary policy the Fed has embarked on, right? That raising interest rates to slow the economy can have a real lag. it can really take some time before it impacts us, and that's what we're looking for. Housing prices, inventory is very low. Mortgage delinquency is very low. People are figuring out, you know, how to get that paid because the price has gone up, the value's gone up, and the mortgage is really low. You don't want to lose that. That higher interest rate, though, has made it difficult to tap into the equity that so many people have. Right, you used to be able to get a home equity line, and there was a point in time a couple of years ago, several years ago, that you could actually deduct that from your taxes, and the rates were really low. So it was an easy way to get into some liquidity. That's not quite the same now. It's a little more challenging. I think I'm going to wrap up on a couple of slides here. So we have aging demographic, a couple of downward pressures, right, on inflation and economic growth. We do have an aging population. Excuse me, this is, aging population, and then the participation rates. So we saw a drop off in the participation, the people that are in the labor market pretty significantly during COVID. We've seen a nice recovery, but generally that is trending lower. And that, you know, that affects kind of long-term prospects for economic growth. Difficult finding workers, right? It's, I don't know about you all as business owners, is it as difficult now as it was a year ago to find workers? Yeah. It hasn't gotten any better? Yeah. It's still challenging. The job openings that we do have, 90% of those job openings are in the companies that are 1,000 people or less, smaller companies. An example here, so you probably heard about some of the tech layoffs, so Google, Alphabet laying off people, Cisco laying off people. Right, the tech industry is laying off. Tech jobs are really growing, actually, and it's these smaller companies that we're seeing that growth. So Twitter laid off 5,000 people a few months ago out of their 7,500 workforce. It's a pretty dramatic layoff. Only 900 of those were in California, by the way. Those are global companies. Those big companies are all over the world. But of those 900, 300 had jobs within the first week. And so these smaller companies are really snatching up these talented workers. And it's that what is driving our economy. Leisure and hospitality, I mentioned that before. It's interesting, we're here at Universal Studios, right? This is really starting to come back. I want to actually get to a little bit on commercial real estate. I meant to go backwards here. So commercial real estate is something that we're paying close attention to, and it's not all the same. So you think about multifamily, you can think about industrial, you can think about office and retail. The real problem we see ahead is office. Return to office is just not quite happening yet. Everybody went home. About 70% of the mortgages in the commercial space are with small banks. So the banks like Bank of America and US Bank, the large banks, don't hold as many of those. But there's this big divergence. And so the idea is that people aren't necessarily returning to the office. And the vacancy rates here in Los Angeles are in close to 30% for office. It's concentrated in older office space. Right, so the newer spaces have the amenities, they have the more recent leases. It doesn't mean that everybody's showing up to the office, but they do have leases in place. And so with the older buildings, as those leases come due, people are taking stock and saying, well, gee, I don't really need all this space, or I can go over here and it's a much nicer building. And there's a real challenge with that, coupled with commercial lending tends to be shorter term in nature, maybe 5-year loans that are coming due. And then the interest rates being much higher, we're seeing people sort of give up on that. And multifamily, by the way, holding up quite well. Housing is so expensive, people need to live somewhere, and so that's holding up well. Vacancy rates around 5%. Industrial is on fire. Warehouses, that's, the vacancy rates there are about 1%. The growth in the price of those leases is significant. And retail, by the way, is making a comeback. Office today is being compared to retail, 5-6 years ago, where retail was dead. Well, retail is starting to come back a little bit, primarily in restaurants and bars. Turns out people want to be together, those experiences. And so we look at the different sectors. For example, there are REITs or real estate investment trusts. We look at investments. in different sectors of the commercial markets. And you can look at a REIT like Essex and a big apartment REIT. And we go back to 2016 where it was peaked to where it is now. Essex is down about 10%. Hudson Pacific is one of these office REITs, down about 86% from that peak. And then warehouse, Rexford REIT in warehouse space, up close to 150% during that time period. So real divergence there, which presents some opportunities as well. Talked about the deficit. I'm going to wrap up here. I'm not sure if I have time, but I know we want to get to some Q&A. But the deficit is looming, right? You know, the more every year we run a budget deficit, and so the national debt keeps growing. I think, you know, this is a problem that presents itself significantly in the coming couple of years, crowding out other investments, especially with interest rates, the debt service being so high. So something has to give there, right? Either stop spending as much, right, or raise taxes. Something has to happen. Demographics, this is what I was touching on before. We're getting older generally as a population, which is downward pressure on growth. Yeah, and population is getting smaller, and birth rates are getting smaller as well. So that's kind of the big picture. I want to give us some time for some Q&A, and look forward to interacting with you guys. Thank you. Sorry.
Thank you so much, Barbara and Bill. I believe there's a member of the VICA staff who's going to be walking around with a microphone. Is that right? Great. Oh, good to see you. I was like, where are you? Voice of God. Hey, you know, I said something wrong earlier today. I would like to correct it. I said that VICA is the premier business advocacy organization in the San Fernando Valley. That is not true. VICA is the premier business advocacy organization in Southern California. And I, for one, am really proud to be a part of it. So, and thank you to our economists for giving me some good news, because I got to sell some stocks to pay my credit card bills. So we're going to take some questions from the audience and a few from me. Abby, if you're in the audience, maybe we'll start with a question from the audience. Any questions? This young lady over here has got a microphone for you.
Good morning, thank you for your presentation this morning. I want to ask specifically about California, and a lot of talk about population exodus, business exodus, high costs of doing business, and I'm wondering how California does compared to other states and the state across the country in your forecast.
Yeah, well, so I'm going to focus on really those states that have 5 million or more in their population. I think it's kind of more relevant. So if we looked at Delaware, you know, it'd be kind of skewed a little bit. What we're seeing is California is growing and trending higher than the nation. There are kind of at the aggregate level of GDP, there are some states that are growing faster than us, Tennessee, Texas, Florida. There's a lot of development going on in Tennessee. But when we look at the per capita growth, you know, when we consider how many people are here and what our growth is, California is growing at the fastest rate in the country of those larger states. So we're seeing, again, people are leaving, but we're also seeing a huge investment in California so the government, I mentioned defense spending, $60 billion. You think about venture capital investment into California. So nationally last year, about $240 billion of VC money was invested. 104 billion of that was in California, 43% of that. So you look at Texas, that number's around 4%. Florida's like 3%. So really significant investment in California. The onshoring I mentioned of technical activities, this idea of, you know, biotech, AI, aerospace tech, these high-paying manufacturing jobs are coming here to California. So despite those, you know, issues, which are very real, we still have a lot of positives here.
Any other questions? Right here in the front. Barbara, did you have anything to add to that comment?
Just that our bond.
This lady has wonderful hair. Why so little action and so little concentration on the national debt? What a travesty.
Yeah, I'll start with that. Just adding to the comments on California, just before I answer that question, but you know, just to the point about the California budget, we do have such a big revenue stream from tech that it's covered, and frankly taxes, that our bond rating's still very good. So despite the exodus, we're still able to refinance at a really good way, and the state hasn't had to issue bonds. We've had an incredibly tough time actually finding California municipal bonds for our clients. So the deficit, yeah, I think it's complicated. I think it's a complicated topic, and it hasn't been, you know, we had this great run in the 1990s where we were at a surplus. It's going to get a lot more attention. It's growing to the point where it will start to constrain spending, and it's going to be a huge burden for future taxpayers to cover it. Until there's some type of sustained cut to federal spending, the deficit will basically drive longer bond prices higher. And that's globally. I mean, globally there is a deficit problem in a lot of countries, so the US isn't alone, and the US does have a better growth engine than a lot of countries, but it's gonna get more attention, and I think it'll ultimately drive valuations lower for a lot of assets.
Yeah, it's a hard problem. It's a hard problem. It also, you know, introduces, you know, philosophy, you know, and politics into the equation, right? Should we be spending as much? Should we be taxing more? You know, those are hard questions. Something has to happen. It's not sustainable. I think it also implies that we're not going to see, although we're in the same camp as Barbara and Bank of America, higher for longer with rates. You know, they're telling us they're going to go higher for longer, and we believe them to get inflation under control. But you can't go much higher and continue to service that debt. It just crowds out the spending and the ability for the government to do the things that it needs to do. And so something has to give there. The hope is, and hope's not a great strategy, that the economy can grow through that, can grow us out of that. And there are some economists that you know, think that that's possible. But it's something that, you know, we've kicked the can down the road so often. So every year, right, I mentioned this, that there's a budget deficit, there's more debt. And that just keeps growing, and you saw that chart trending up. Something we're going to have to face and we're going to have to deal with within the next few years.
While we're heading over there, I just have a quick comment and question. You know, a lot of times you come to these things and you have folks in your position who talk about why Texas is better or Florida is better. And I always find that frustrating because we are a California-based business association, and so it is refreshing to hear your comments. I do have a quick question, Abby, before we go to the audience question. To push the envelope a little bit on what I just said, that was a caveat. If you all had a 21-year-old who's a senior in college, would you encourage them to come to California or Los Angeles County and start their career?
I'll answer it because I do have a 21-year-old senior in college. So she grew up here, and that probably lends a certain amount of bias. But, and she's a creative type, but she's also an economic thinker. The thesis has been, ever since the mattress store down the street for us turned into a just food for dogs, that LA would degentrify, and she's planning to buy real estate. You know, in her head, she's nowhere near able to do that at this point. But she's no way planning to leave. And I find that very interesting because her dollar could go a lot further in other states. She's not interested. She loves the environment. She loves the creativity. She loves all of the diversity and different things to do and the beach and the mountains. So, and with my client base, which is a lot older than 21, a lot have moved out of state, but a lot of them just say, you know what, it's the best weather, and 2023 would be a great example of that. So we pay a weather tax, and we love the arts and the diversity. That's my answer.
All right.
But yeah, so the ones I know, not going anywhere. Maybe they'll go to the Bay Area.
A weather tax.
I have something
Bill.
to add to that. Yeah, I mean, I think one important aspect is we talk about people leaving, right? They're going to Austin, Texas, and Boise, Idaho, and Salt Lake City. Those places are becoming more expensive too now. So we do pay a premium to live in California, and we have a lot of amenities that come with that premium, but that premium is becoming smaller. Those other places, you know, on a comparison basis, are becoming more expensive. So,
Abby?
So on a related note, you mentioned the constrained housing supply, and you mentioned the high mortgage rates. Are there any bright spots or trends in the housing market that you can point to, or for California?
sorry.
No.
Okay, so just, I mean, building permits are on the rise. That's a bright spot. And by the way, during the COVID era, they were they got smaller, the number of building permits, but not as much as the rest of the nation. So that's what has to happen. We have to have more supply, and it's not enough to grow us out of our problem with the shortage of housing here, but those permits are increasing. Multifamily housing is going up throughout the Southland, Southern California, kind of Orange County, Los Angeles. So that's, you know, improving somewhat. And look, interest rates are not going to stay high forever. There will be a cycle, and the economy will slow, and unemployment will go higher, and interest rates will fall, and that helps with affordability. ADUs, auxiliary dwelling units, also, you know, helping on the margins, so the ability to build these additional units on your property. Measure H, so some legislation helping it make it easier for builders and the permitting process. We can circumvent at the state level the local policies around the difficult building permit process. So some of those things are helping with housing.
Okay, we've got a question over here in the front.
I'm coming.
Oh, sorry.
Well, it's gentleman with the laptop, but we can spread the love around.
So like recently I watched a documentary about how like many buildings in New York that are older, as you mentioned, aren't going up for like, you know, leases and stuff, like, sorry, not leases, like, you know, up for grabs for many companies, and how they're converting them into like housing units and stuff like that. Instead, do you see that as like something that's going to happen in California and like San Francisco or something as well?
Conversion of commercial real estate to housing.
It's difficult. The New York Times has done they did a really in-depth article on what it takes to convert an office building into residential. It's almost impossible to do it cost effectively. I heard about a project on the Santa Monica Promenade where they were converting some commercial space to pickleball courts. I like that. I mean, I think like my daughter goes to a climbing gym, like where, you know, they basically took this unused space and stuck things on the walls so they could climb up and pretend they were mountain climbing. I think it'll get more creative. Residential, I live in Hollywood. I see a ton of buildings going up. I don't know how many of them are going to be profitable, but I see a lot of units coming, and they may not end up getting the prices they want, but there's plenty of building, at least from my vantage point in the apartment space. And ultimately, if apartment prices get low enough, it'll drag down single-family prices eventually. You know, just more creativity. And then just another trend that we're seeing more of is families living together, which never used to happen. But, you know, you may have an in-law suite that actually is occupied by an in-law. And that's a really slow trend, but just with costs and childcare, it really makes a lot of sense for a lot of different families. So we may see more of that as well.
Stuart with our last question.
Oh, I got the last one, okay. As you mentioned, big tech props up a lot of our California economy, but we've also noticed in the last few years, tech has been enticed to relocate their headquarters to other states. So what can be done to keep these big tech headquarters here in California and not be tempted to go to, say, Texas?
Probably legislation. But I think a lot of the move's over. I think, you know, there was this initial push during COVID because a lot of people relocated. And like Bill said, those other areas are getting more expensive. And then you've seen some, you know, like the grid failure in Texas this year. You know, it's not like Shangri-La everywhere else. But, you know, prescriptively, I think the governor is working on it because it is a huge tax engine.
Yeah, taxes are a big part of that equation. And so we live in California. We know we have high taxes here. By the way, that helps our bond holders, right? They're going to pay us because they're generating all that revenue and taxes. But again, I think we saw most of the job growth now is in those smaller companies. Those global companies, there, yep, you know, Tesla, by the way, one of the big 7, just moved to Austin last year. So we used to have 5 of those 7, now we have 4. It's happening, you know, unless we see some significant changes. But the amenities here and the talent that's coming in here, I think, keeps us sustained. And the growth really is in AI, right? This huge push in AI. These are smaller companies. You know, we've got the universities, we've got the talent, we've got the people coming here. So that $500,000 people migration out, right? That doesn't mean just 500,000 left. It means 500,000 more left than came in, but those people that are coming in are high earners with those degrees to be able to work in the advanced manufacturing, and so that per capita GDP becomes stronger. But it's an issue.
Let's give a big round of applause to our economists. Thank you for joining us this morning and for all of the great information that you provided. Before you all get up, we have a few housekeeping items to get out of the way that you need to know. We are excited to have a lunch program this afternoon with the CEO of Edison International. I saw my friend, and he's been a bit of a mentor to me, David Ford was in the room earlier today, so happy to see that Edison is in the house. Pedro Pizarro as our keynote speaker. Most importantly, remember to complete your bingo card that you received at registration by visiting all exhibit booths, and you will have a chance to win some of the following items. A round-trip ticket from Southwest Airlines. Woo, that's, come on, give it. You guys, did you not have enough coffee? Come on. I've been up here, no food, no coffee, I got more energy. A Valley staycation from the Garland. Ooh, Jewelry from Kendra Scott. There we go. And what I want, Maria, a signed football from the Los Angeles Rams. Now, I know some of you have already started getting your bingo stickers, and now you have some time before the next panel to get some more. Let those exhibitors know that we appreciate them being here at 6 a.m., much earlier than me, to get set up and ready for you. We have another raffle, too, for anyone that dropped their business card in a bowl at registration. That includes a gift card from Liana Treat and Berry, DoorDash gift card, a Brent's Deli gift card, and 2 gift certificates for the Hilton Seafood Buffet. I didn't know that existed. One more time, let's give a nice round of applause for our economists and for our breakfast sponsors, Bank of America, and our presenting sponsors, Amazon and SoCal Gas. You don't have to clap for Amazon, just keep your Prime membership, but clap for SoCal Gas. Our breakout sessions will begin at 9:45. You have 30 minutes, and if you guys want to see me doing this again, I'll be back in 2 weeks for the state office holders lunch, or the local office holders luncheon. Thanks, everybody.